Hey guys, welcome to an all new episode of Dividend Definitions. Now before we jump into this, if you guys like my channel or if you guys like this video, don't forget to leave it a thumbs up, leave a comment down below. Don't forget to subscribe, and you can even share this video with your friends. It would help me out a lot. Now I put some link in the description down below so you guys can check these out. They have information concerning dividends and dividends investing, as well as other kinds of investments you can do. So you can check that out for some more knowledge on investments. Now today we're going to talk about the dividend policy. Now this may sound basic, this may sound obvious, but it's important to know the differences in dividend policies that a company can have. Now, what is a dividend policy? It's like a game plan. When a company comes to paying out dividends, it's sort of a preset game plan that they're going to have as a company in general when they're going to pay their dividends. Now, you have three examples of these. The first one is the stable dividend policy. Now, this basically means that if a company decides to pay a dividend and adopts the stable dividend policy, well, if I have a company and I decide to use this strategy, I'm going to say, okay, my stock price is, let's say, $10, and I'm going to give investors $1 every single year. And I'm going to do that no matter what, okay? Which is the stable part. So no matter what happens, my interest, my earnings go up, my earnings go down, my price per share goes up, my price per share goes down. It doesn't matter. I'm going to give them $1. So the good thing is here for investors, if the price per share goes down or if the earnings go down, it's not reflected in the dividend that they're going to receive. So they're going to keep receiving $1 per share that they own all the time. So that is the stable dividend policy. Now the downside to that is if my price per share shoots up, or if I have a really good year or even a really good decade and the price per share jumps up to $100, well, good thing is they have the stock, so they've increased their price per share as well, but they're only still receiving $1 per share. That's just a 1% versus the 10% they were receiving before. So if you're a dividend investor and you're relying on that compound to get your growth, then you're not going to get that necessarily with a stable dividend policy if the price per share just shoots up. But if it goes down, your yield increases because the dividend paid is the same. So that is the stable dividend policy. You have the constant dividend policy, which is the second sort of policy that you can have. Now, the constant dividend policy is a little different. It reflects the company's earnings. So if I have again, a price per share of $10 and I give $1 to the investors per every single share that they own, so a 10% dividend, and my earnings for a single quarter, they increase, they jump up. Well, I'm going to give them a reflection of what my earnings were for that quarter. So I'm going to say I'm going to increase the dividend because my earnings were very good in this quarter. But on the contrary, if my price per share, if my earnings, they go down, they drop, I have a really bad quarter, a really bad year, then I'm going to have to say, you know what, investors, I'm going to have to cut the dividend or just completely annihilate it, completely shut it off because my earnings were so bad. I can't afford to pay you guys a dividend. So it's sort of a reflection of what the company does as earnings. So it's a bit more organic sort of payment in terms of dividends because it reflects what the company actually can afford to pay. But on the downside, it's not a very stable dividend, so you can't rely on that to compound and to grow your dividend portfolio. So, has advantages, has disadvantages. The third sort of dividend policy that you have is the residual dividend policy. Now, if you take that a step further, if you take the constant dividend policy a step further, so you get your earnings. The company says, you know what, I had a great quarter, my earnings went up by 50%. So I could afford to give out more dividends. What the difference is here between the residual dividend policy and the constant dividend policy is that the residual dividend policy is not going to reflect earnings, but it's going to reflect the amount of money left after a company has done paying every single thing that it should spend on, every single spending that it has done. Whatever's left over after all of that, that's what it can afford to pay as a dividend. So again, it is less reliable, it's a little bit more volatile, but it's even more organic than the constant dividend policy because a company's not going to take out any debt to pay you a dividend in this case, because they're going to say, you know what, we've had an increase in our earnings this quarter, but it came with a price. We've had to invest a lot of money. We've just purchased a new company, so we've had a lot of investments to do. So our earnings increased, but our costs per share as well. They increased for this quarter, so we don't have a lot of money left. We can't afford to pay you guys the dividend that we usually do. We're going to cut it down just a little bit for this quarter, and we'll see next quarter whatever's left over after all our spending, and give you guys an according dividend, accordingly to whatever is left after that. So stable dividend, it's the same whatever. You get $1, you keep getting $1 no matter what. If the company drops, they're going to have to, they're most likely going to have to take out a loan to give you your $1. So that's a little bit more reliable, but again, it's not very organic because the company is just going to hurt itself to pay you guys a dividend. The constant dividend policy is a reflection of their earnings, but not their spending. The residual dividend policy is a reflection of their earnings, is a reflection of their spending as well. So there you have it, guys. Those are the three main differences in dividend policies that a company can have when it decides to be a company that pays dividends. So it's important to know these the differences here, because if you decide to invest into a company and you really want that dividend, you want that dividend to be reliable because you're depending on that for, I don't know, monthly income. Let's say you're retired and you really want that monthly income to come in, and you adopt a company that uses a residual company policy, then you might not get that monthly income that you're relying on. So it's important to choose accordingly what kind of investments you want to use. So I hope you guys liked this video. If you did, again, just leave a thumbs up down below. Don't forget to subscribe to the channel, leave a comment, and don't forget to share this video. So again, if you guys have Twitter, you can log on and follow me on Twitter. You'll be notified as soon as a new video comes out. Thanks, guys. Have a good one.